Hi, this is Cathie Wood, and you are watching Market Insights.
Welcome back to ETF Market Insights. I'm your host, Erin Allen. And in today's session, we'll be discussing all-in-one portfolio solutions, also known as asset allocation ETFs. These are relatively a new innovation in the ETF space, about 5 years old. And they really offer investors a simple to use, low-cost solution that I think really checks a lot of the boxes when it comes to portfolio construction. So we're going to take a deep dive into some products that are unique to BMO, again, all-in-one solutions, but those that are really focused around producing a higher level of income or cash flow in your portfolio. So we're going to get into some of those as well. Just as a reminder, today we're not providing you any advice or investment recommendations. Today's episode, just like all of our episodes, is focused around investing in ETFs, and really just providing education for Canadian do-it-yourself investors. With me today, I have Chris McHaney. Welcome, Chris. He's the Director Portfolio Manager with BMO ETFs. And Chris really helped shape a lot of our asset allocation ETFs, so I'm looking forward to our discussion with him today. Before we do get started, I just want to give a quick reminder to check out our YouTube channel. You can watch any of our past episodes here. We've been doing this for 2.5 years or so now, so there's lots of great content there. Remember to subscribe, ring that bell, that way that you're actually going to get notified directly when new videos get posted. Okay, let's get right into it. So asset allocation ETFs, again, we like to call them all-in-one ETFs. These were introduced to investors in Canada just a short time ago. BMO launched our suite about 3 years ago now, but there's many choices in the market for Canadian investors to look at, from iShares, Vanguard, Horizons. Most of the providers have come out with these solutions, and they've really skyrocketed in popularity with billions, if not trillions of assets tracking these now across the different ETF providers. And I think this is really a testament to investors recognizing the benefits that these bring to a portfolio, which we're going to get into. So what these are is really just a basket of 7 to 10 different underlying ETFs that are professionally constructed for you to these strategic asset weights. And a big benefit is that they rebalance for you back to their selected asset mix. So a few examples here include Zcon, our conservative ETF portfolio, 60% fixed income, 60% equity, 40% fixed income. And this is for those investors with a shorter time horizon, more risk-adverse investors. We have ZGROW, our growth ETF portfolio, which is an 80-20 mix for those who are, more growth-oriented investors, longer-term time horizon. But we'll get into some of these a little bit more detail going forward. Chris, I want to bring you in. Can you run through the benefits of these solutions? Why are they so popular right now?
Sure, and really, I think the benefits of these ETFs go back to the traditional benefits we think of that made ETFs popular in the first place, right? They're highly liquid, transparent vehicles that generally track broad market indexes. So you get instant diversification across hundreds, if not thousands of securities with one purchase. As I mentioned, they're transparent as well. So you know what's in there at all times, and highly liquid, easy to trade in and out of. And so again, some of those more traditional ETF benefits that we think of. But these all-in-one ETFs also have a couple of other benefits. You mentioned professionally constructed. So instead of an investor having to go out and decide which 5, 6, 7 ETFs do I need to make up my core, this is already done for you by a professional money manager. And so again, with one purchase, you can get access to each of those ETFs within that bundle. Again, each of those ETFs having exposure to hundreds or thousands of securities potentially. And then, as you mentioned as well, the automatic rebalancing feature to make sure that the asset mix and the risk return characteristics that an investor was after when they first purchased that ETF stay within those same bounds due to market drift, things like that. Asset allocation can get shifted around if an investor just had a buy and hold strategy. But if you have one of these all-in-one ETFs, that rebalancing is done automatically for you to keep you on track.
For sure. And one of our colleagues often refers to these sort of simple on the outside, sophisticated on the inside. And I think that's a good way to explain them. So let's look under the hood a little bit. Can you walk us through what these are made up of in a little bit more detail and how they're actually constructed?
Sure, and you can think of it as, each of these portfolios has two different sides to it. There's that fixed income allocation, and then there's that equity allocation. And looking at equity portfolios from a Canadian investor's point of view, there's four major geographic regions that you would possibly want exposure to. First of all, the Canadian market, of course, our home market, very important for most investors, as that's where you live and that's where you make your own living. And so having access to that Canadian market is important, of course. The US market, the largest stock market in the world, or the largest economy in the world, very closely tied to the Canadian market as well. And then outside of North America, you have developed markets, and that would include things like Western Europe and Japan, a little less risky in terms of equities, and then on a bit more riskier spectrum, the emerging markets, which would include things like China, India, Taiwan, Korea, those developing nations that have a little bit more volatility to them, and so might want a little bit different allocation than what some of those other developed markets have. And so again, on the equity side, you have access to all four of these regions in these all-in-one ETFs or in these asset allocation ETFs. And then on the fixed income side of things, Canadian government bonds, as well as diversified exposure to corporate bonds, so both Canadian corporate bonds and US corporate bonds, gaining that diversification across companies so that there's no undue risk in any one sector or any one company, and all investment grade fixed income as well. So you have, again, these two sides to the portfolio, fixed income and equity. You put all those together, and as you can see here with our balanced ETF as the example, exposure to over 4,700 different holdings within that one portfolio. So by any investor purchasing this, and again, for as little as you want, $100 if you want to invest that. If you don't pay commissions on your ETFs, potentially you can invest even less than that without worry about, the cost of trading, and you get access to, again, over 4,000 different securities in one ETF that's tailored to your risk return profile.
And a lot of investors are probably thinking, can I just build this myself? And you can absolutely build it yourself. But what these ETFs provide is just that simple solution, that automatic rebalancing, right? It's very hard to rebalance a portfolio and cut your winners, so to speak. So yes, you can do it yourself, but really this is a low cost solution, 20 basis points to have it all managed for you. And as you mentioned, often these are trading for free on a lot of the discount brokerage channels as well. So depending on the commissions you're paying, it makes a lot of sense. So we talked about, you can build it yourself, but also thinking about what your asset allocation should be is an important decision too. Why is that asset allocation, that mix between stocks and bonds and other asset classes, so important?
Right, and there's been numerous studies, and you can see the results of one popular study here on the slide, and again, there's been many of them, but they all come to the same conclusion. Your asset allocation mix is the primary driver of the volatility of the returns of your portfolio. So for any investor, how volatile your portfolio is, how different those returns are from month to month is largely driven by the asset allocation decision. And you can see here the study saying over 90% of that variability comes from just that asset allocation decision. So it's really the most important decision that any investor should be making. It's the first decision any investor should be making when deciding how to build out that portfolio, what to invest in, where to invest. Really, that first question you should ask yourself is, what's my risk return tolerance? What's that ideal asset allocation mix for me? You answer that question and you build your portfolio around that. And so again, really right from the top of any investor's investment planning, that question comes first, and therefore these type of solutions can help you answer that first question and build out that core of your portfolio in order to get that ideal, again, risk reward trade-off, that risk return trade-off that everyone's looking for themselves.
Exactly. And we've talked about rebalancing a lot. I'm a very emotional investor. I have trouble, rebalancing myself. But I think this is a good illustration. Can you walk us through how this automatic rebalancing is just such a great benefit for do-it-yourself investors?
Sure. And, first of all, again, we'll just go back to the first point that if an investor did do all this themselves, and they certainly could, you buy a portfolio of investments that, let's say you wanted a 60% allocation to equities and 40% to fixed income. As the market moves, if the market rallies, that 60% equity weight becomes 62, 65, could get significantly away from that original 60% target. And that's okay if equities are performing well, but what it's doing is really adding to the risk embedded in your portfolio that, again, maybe you didn't want to begin with. You wanted that 60% allocation. So, rebalancing, first of all, the most important element of it is to make sure you're sticking to that asset allocation mix that you wanted in the first place. But what you can see here is that it also adds the potential for having a higher return overall. You kind of alluded to the fact that it's actually very hard to buy stocks when they're at the low. Just psychologically, markets have sold off probably. You don't want to be putting money to work in that environment. And conversely, when markets are rallying and doing very well, you don't want to sell at the high points either, because you want to keep your money invested. You want to keep that growth going. So psychologically, it's very hard to buy low and sell high, which at the end of the day is what every investor wants to do. You want to buy something or invest at a certain price and sell it at a higher price. That's the whole point. And so we can see here that automatic rebalancing, or revisiting that portfolio on a regular basis, whether that's quarterly, semi-annually, or again, just holding an asset allocation ETF that does it for you, by trading down those stocks that have rallied, or those holdings, those ETFs that have rallied, and again, if that asset allocation moved up to 65%, selling it back down to 60%, in essence, what you are doing is selling those investments that have done well for you. So you're selling high, and then at the same time, you're buying those ones that are below what their current target asset allocation is. And so you're investing in those areas that haven't done as well. And so you're buying low. And so this automatic rebalancing really reinforces that buy low and sell high approach. And essentially what you're doing is locking in gains when you're selling high, when you're selling those winners. And you can see here what that does is over time actually can add up to 1% annualized in terms of your performance, overall performance, while at the same time keeping your risk in line with what you wanted it to be to begin with. And so this is really a key feature of these all-in-one ETFs that make it really easy for investors. Again, it's hard for an individual investor to do. If you're paying commissions, you don't want to trade smaller amounts and pay that commission. And so it could be really hard for an individual investor to do this sort of approach, but these all-in-one ETFs will do that for you. You don't even have to take a look at it. It'll all be done for you, and hopefully you get that higher return from the auto rebalancing. I
keep looking for an update on this study every time we use this image, but I think it would look even better after the past year, but hopefully we'll get an update soon. So that really does cover off a lot of the benefits, but let's turn to how you can actually use these in a portfolio, because there are a few different ways. So can you walk us through how an investor might choose to use these?
Sure, and you can see here on this slide the concept of the core satellite investment approach, where you have your core holdings that make up the majority of your portfolio, and we think asset allocation ETFs are a great solution for this part of your portfolio. Let's call it, for example, 80% of your overall total portfolio can be invested in that core. That's going to keep, again, your risk return profile on check to where you want it to be. And then you can add on the remaining 20%, or whatever you want that satellite position to be within your portfolio. You can add around the fringes these different exposures that you might be interested in. So, some do-it-yourself investors, they really like being involved in the markets. They really like taking a look at, what sectors or what countries might be doing well going forward. If you want to add on a little bit of a sector exposure, if you think Canadian banks, for example, are well positioned to do well going forward, you might want to add a little position in the Canadian banks by buying an ETF there, or by buying a different sector ETF in the technology space, for example, if you think that's going to do well. And so what you're doing is, again, making that core holding on to that core and making that just that broad market exposure that's going to really drive your returns overall over the long term. And then, you know, with the fun part of investing, adding around the edges, but not changing your overall exposure too much, but still, you know, trying to pick those winners and avoiding those losers that a lot of investors really enjoy doing, and putting that in your portfolio, but doing it in a more responsible way, in a more risk-controlled way. You know, one thing to mention here, again, if you're thinking about the core being that asset allocation ETF, and then the Explore adding on top of that, you might want to take that into account when you're deciding which asset allocation ETF to buy. If your Explore or your Satellite is going to be 20% of your portfolio, and that's going to be all equities, you know, you might want to tick down on the core asset allocation ETF. You might want to tick down the risk because you know you're going to be adding more equities to that. And so, again, that's just one thing to keep in mind. You know, the other approach is simply just holding that core investment, that all-in-one ETF as your primary holding. A lot of investors don't enjoy following the markets and trying to pick those winners and losers and trying to chase returns. And so you really just want to put your investments in, you know, not really look at it from day to day, and use that all-in-one asset allocation ETF as your primary holding, and then, you know, revisit that semi-annually or annually or whatever you like to do there to make sure you're still on pace and that's still the right asset allocation mix for you.
I do really like that core and Explore strategy. You know, gives you something to talk about at that dinner party still, and you know, maybe you work in a specific sector and you really see huge growth potential in that sector. You can always add that into the Satellite too, but still keep that well-diversified core. Let's turn to, I really wanted to spend a bit of time today talking about some of our income-focused all-in-one ETFs, because we get a lot of questions on how to increase the cash flow in investors' portfolios, a lot of retirees out there. So this is Rebalancing. We launched that earlier this year. Can you walk us through what a T-Series is and how this actually works?
Sure. And so, you know, mutual fund investors might be familiar with that term T-Series. You know, we've, as you mentioned, brought that to the ETF structure as well. And this is meant for investors that really want a regular distribution coming out of their portfolio. So they want that income coming out of their portfolio. In the case of Rebalancing, this is the same portfolio as the standard Rebalancing portfolio. You know, you're in 40% equity, 60% fixed income, diversified across those geographies and sectors as we discussed previously. So you're in that same overall portfolio, but you get a regular monthly distribution as well. And so you can see on the slide here, the distribution is set to 6% at the start of the year. So if you take a look at the NAV at the beginning of the year, let's say the NAV was you know, $10, 6% of that would be 60 cents, and that's paid monthly over the course of the year. So 5 cents a month over the course of the year. And then the next year, that amount will reset to be 6% of whatever the NAV is at the end point of that year. And so what that's doing is, again, creating that nice cash flow out of these investments for you. You don't have to go in each month and sell a couple of units in order to get that cash flow. It's all done for you through a monthly distribution. Now, it's important to point out here that the fund itself, through those holdings, that 40/60 portfolio, isn't necessarily going to earn you 6% over the course of the year. You know, ideally it earns you a little bit more, but in some years you might earn a little bit less than that. And so investors just have to understand that what you're getting in here is not necessarily income that's earned in the portfolio. What you're just getting is a piece of that total return coming back to you in the form of a monthly distribution. So, you know, that could eat into the NAV potentially. Again, if you're not earning 6% in that one given year, that NAV will be depleted a little bit. But investors in this series understand that, and they also understand that, of course, if the market goes up more than 6%, then you're certainly catching that 6% distribution, and you're also earning a couple percent in growth on top of that.
For sure. And then investors can always go online and figure out how much of the distribution over the year was return of capital and how much was capital gains or dividends. So something that you can always investigate for yourself on the ETF provider's website too. Once it's gone through a full year, of course. Let's look at ZMI, another option, our monthly income ETF. This ETF is actually 10 years old, so I think we were actually first in the space, but they weren't called asset allocation ETFs at that time. But this ETF is great for investors who are looking for that dividend, higher yield approach, or like to use covered calls but don't really know how to construct that portfolio. Walk us through the monthly income ETF.
Sure, and this is very similar to the last ETF, Rebalancing, but as I mentioned, for the T series, you're not necessarily earning that distribution that's being paid out, and the investors understand that. For other investors that want a distribution, but also want investments that earn that distribution, that earn that yield, ZMI is a perfect example for them. And so it's built in a very similar way to those other asset allocation ETFs, very similar to that ZBAL portfolio. But instead of the broad markets making up the underlying investments, S&P 500, TSX Composite, we're invested in dividend-oriented strategies on the equity side, and corporate bonds is the tilt on the fixed income side. And so what that's going to do is create a portfolio that's similar to that 60-40 portfolio in terms of overall risk, but it also has a high level of yield that it can pay out on a monthly basis. And so again, if we take a look at the equity side of the equation, instead of investing in those broad markets that are primarily for growth, we're invested in dividend-oriented ETFs, similar geographic exposure, so Canada, US, developed international, as we mentioned before. But again, they're tilted towards companies that pay dividends and growing dividends over time. As well, there's a little bit of covered calls in there, as you mentioned, that adds on an additional layer of income for investors. And I think a lot of investors are familiar with covered calls and how they add additional income into a portfolio, generally tax efficient income as well. And so you're getting an equity portfolio that, again, is created similar to the other asset allocation ETFs, but is giving you that distribution on a monthly basis through dividends and through those call option premiums. And then on the fixed income side, again, primarily corporate bonds that have a higher yield than government bonds do, can also help to meet that monthly payment option. And so what you're left with is a portfolio that should pay you regular monthly distributions, but are earning those distributions and then can grow over time as well.
Perfect. So I love those two options. Zval.T, that's sort of guaranteed 6%, but you might be earning some return of capital in any given year, and then ZMI, which really looks to go get that yield and pay out a sustainable yield of what it's earning. So that's great. Thank you. So that really covers off the deep dive of these all-in-one ETF solutions. We have 6 different options. We didn't get into all of them today. One other one that I wanted to highlight was our balanced ESG exposure, ZESG. We do have a lot of interest in investing to avoid or to mitigate these environmental, social, and governance risks. So this is a great option for an all-in-one solution that help you align your values with your investments. But you can look at all these on BMOETFs.com. Have a look at our beautiful new website, which just launched a couple of weeks ago. Hope you've had a chance to check that out. I do want to turn to our audience questions before we wrap up. We have a couple of those. And just a reminder, please submit your questions. You can do that on etfmarketinsights.com, and you can also do it on our weekly Tuesday email. We have a question button there too, so please keep them coming. So Chris, I'm going to turn this one over to you. Your thoughts on the latest inflation numbers and what you expect in terms of the markets going forward.
Yeah, and so what we've seen most recently is, I would say a little bit of a softening in some of the inflation numbers that have been reported recently, and the market has really digested those very well. Equity markets and risk assets in general have rallied on the back of these inflation numbers. And really what they've shown us is that potentially inflation is peaking or has peaked. And so those runaway prices that we've seen, really in all areas of the economy are starting to slow down. They're not continuing to run away at super speed, so to speak. And so, again, the market really digested that well. That's a sign that, central banks can also start to slow down potentially their pace of interest rate hikes. And so again, that's something that the market has received very well. I think investors should still be cautious because this is only really the first step of slowing down the economy, is getting those inflation numbers to peak. But then we also have to see those numbers start to come back down as well, and hopefully they do come back down to what we witnessed previously, and not just stop halfway down there, right? And so this is really just the first step, and so investors should still keep an eye on these inflation numbers, see what direction they're going in. Hopefully they do start to come back down, but then the question will be, do they continue to come down, and how far do they come down?
Yeah, nice to have a little bit of positive news for a change. We'll see how this looks going forward. Okay, this one. What is the last date to tax loss sell? So I can take that. The absolute last date is December 28th. That enables you to settle before the end of the year. A lot of investors do it before that cutoff, though. And if you want to learn more about tax loss selling, just a quick plug for the video that we did last week with Alfred, where we went in depth into different tax loss strategies and how you can use ETFs for those too. So check that out if you want more info on that. But that caps off another great week of ETF Market Insights. So thanks, Chris, for joining me again and for all your great insights. Next week, I'm very excited. I'm going to be joined by Cathie Wood, the legend herself, founder and CEO of ARK Invest. ARK focuses solely on disruptive innovation. So of course, that's our topic for next week. They're focused really around 5 technological innovation themes. So artificial intelligence, robotics, DNA sequencing, energy storage, and blockchain technologies. So really looking forward to that conversation next week. BMO and ARK have partnered to bring 3 of their flagship ETFs to Canada, which were listed this week. The tickers are ARKK, ARKG, and ARKW. So their flagship innovation fund, the Genomics Innovation Fund, and the Next Gen Internet Fund. So they trade under the exact same tickers as they do in the US, but they're now trading here on the Canadian exchange in Canadian dollars for Canadian investors. So to learn more about some of these technologies and these products, and to hear from Cathie Wood herself, please join us next week. I'm looking forward to it. I'll see you then. Bye for now.
Hi, this is Cathie Wood, and you are watching Market Insights.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.